Welcome back to the Digital Asset Report. We are back after a week of historic price action. Thursday saw one of the largest single-day drops in Bitcoin history, with the price going from over $69,000 to the low $60,000s. Friday showed an equally impressive rally, which reclaimed lost ground. And now Bitcoin is trying to hold a rebound after last week's washout. The move down looked like a classic leverage reset, heavy liquidations, thinner liquidity, and fast scramble for hedges. Traders are pointing to the options tape too, with elevated put demand clustered around the 60,000 to 50,000 area into late February expiries, which is basically the market paying up for downside protection even as spot bounces. The lead story this week is a reminder that in crypto, operational risk can still move the entire market. South Korea's BitHum disclosed that a promotion error resulted in users receiving Bitcoin instead of a small cash reward, and the numbers were staggering. Reuters reported that at least 620,000 Bitcoin were mistakenly distributed, with some users receiving at least 2,000 Bitcoin each, triggering a rapid sell-off on the platform before the exchange froze trading and withdrawals for affected accounts. BitHum says it recovered 99.7% of the Bitcoin, but the incident instantly became a regulatory flashpoint in one of the world's most active retail crypto markets. South Korea's watchdog is now explicitly calling for tougher rules, pointing to internal controls and system stability as digital assets get pulled deeper into the traditional financial perimeter. Regulators have also raised uncomfortable questions about whether exchanges are maintaining clean, auditable inventory records, because if a platform can accidentally send more Bitcoin than it holds, the credibility of the whole system gets tested in real time. On the corporate side, the story is miners and balance sheets, not Bitcoin buying. Cango, the NYSE-listed Bitcoin miner, disclosed that it sold 4,451 Bitcoin over the weekend, settling in USDT for roughly $305 million. The company framed the sale as a move to strengthen its balance sheet, reduce leverage, and fund a strategic expansion into AI compute infrastructure. In a market that's already sensitive to forced selling, it's another reminder that miners can turn into sellers exactly when the prices are weakest. Meanwhile, stablecoin rails keep getting built even as prices chop around. Circle announced a partnership with Polymarket that will transition the prediction market platform to native USDC settlements in the coming months. More on-chain revenues are choosing regulated, widely used stablecoin settlement over a patchwork of wrappers because it improves capital efficiency and makes the user experience feel closer to traditional finance. Meanwhile, Treasury Secretary Scott Bessent is calling for the immediate passage of the Clarity Act to advance President Trump's crypto agenda. Speaking on the current legislative deadlock in the Senate, Bessent argued that recent market volatility proves that market structure is needed now more than ever. Bessent didn't hold back on those stalling the bill, criticizing some stakeholders for blocking progress and asserting that both banks and the broader crypto industry are largely united in wanting the legislation passed.
I think what we're seeing in the crypto market over the past few months means more than ever that the U.S., we need market structure, we need clarity, and we need to get this across the line this spring. We got a few recalcitrant actors who said it'd be better to have no legislation than the legislation we don't want. And I think both on the banks, the other crypto firms are united against them. So we need to get this across the line. The U.S., under President Trump's leadership, the U.S. is becoming the crypto capital of the world with our best practices, best regulation, and for crypto to remain a viable digital asset and move forward, we need to get this Clarity Act done.
Security is still a mandatory tax on the crypto ecosystem for safety. Reporting this week detailed a breach at Step Finance tied to compromised executive devices, with losses estimated around $40 million. The lesson is a common but brutally important one. You can harden smart contracts, but if the keys and devices are the weak link, your treasury may still be vulnerable. And on flows, the institutional picture is mixed but stabilizing at the margin. CoinShares data showed crypto ETP outflows slowed to 187 million last week after a much heavier wave of redemptions in prior weeks. That is not an all-clear signal, but it does suggest the recent panic phase is cooling, even if the risk appetite is still fragile. The takeaway this week is that the market is being actively shaped by technicals. Leverage is getting repriced, exchanges are being forced to move their operational controls, miners are selling to de-risk, and stablecoins continue to quietly replace legacy settlement in more corners of the industry. Is it a bear market? It's looking like it, but it's also not surprising for a market that has proven to be cyclical in nature. That's it it for today. If you enjoyed this video, be sure to give us a like and follow along for more.